you either have no changes, which means then everything will always be the same, there will only be one Bitcoin, or you keep making changes. And if you keep making changes, there is no possible way to make everyone happy.
Welcome back to Bitcoin.com's Token Narratives, where we discuss the biggest stories shaping the Bitcoin and cryptoverse. My name is Graham Stone, and I'm repping the marketing function over here at Bitcoin.com. And I'm joined this week by Chief Scientist Andrei Terentiev. How are you doing, sir?
It's good to be back. Good to be here. It's only two of us this time. So.
Just the two of us, yeah, as mentioned. A lot of the crew is in Dubai for Token 2049, although I think the conference just wrapped up. And I'm looking forward to seeing the content that's going to be coming out of there that's being produced by our media team. They've been hard at work. I saw images from a yacht that looked fun. All right. So, today we're going to be diving into one of the most heated debates in the Bitcoin world right now, which is, is Bitcoin at risk of turning into a junk chain, or are we just watching a minor technical cleanup that's been blown out of proportion? And we're also going to be getting into some RWA magic, a shift, I think, in the RWA industry towards perhaps bigger and stronger institutional players entering it, and we're going to look at how that is
bullish for Ethereum.
Yes, I think that is a dare I say thing for sure. So, looking forward to that discussion. But first, let's get a little gut check here on the Bitcoin price. Right now, we're doing pretty good this week. We're up on the week. It's about 3% up on the week. Currently, the price is just under $97,000 per Bitcoin. So we've seen quite a run up here over the last month or so, like 20% from the bottom at least. A few bullish points that I've seen recently. First of all, there's this, people have been talking about the miner cost of production. So let me just bring up my screen here. There we got beautiful Bitcoin chart on markets.bitcoin.com. Yes, the miner cost of production. So I've got this chart here, which shows in the green line is the average miner break-even cost, and the black line is the price of Bitcoin. And on this chart, it's showing that whenever the green line, the average miner break-even cost, sort of bumps into the price, but when they get close together, what ends up happening shortly thereafter is a surge in the Bitcoin price. This seems to be a pretty decent signal over the past several years. So that's
basically because they can now start holding their Bitcoins because they don't have to just dump them to try and recoup costs. Is that the theory behind it?
Yeah, I wonder. I mean, this guy who posted this chart, Mitchell Hodel, he says, the historical accuracy of this metric makes logical sense. An asset is not going to trade for less than its cost of production. But I think what the point you made just now makes actually more logical sense. Like, why would this actually be the case? And it could be because, as you're saying,
they can actually retain some Bitcoin
they can hold
now.
it. Yeah.
Okay.
So this is this has got me looking kind of bullish. And then as I mentioned actually last week on Token Narratives, the M2 money supply, this chart here from Raoul Paul is showing the M2 money supply with a 12-week lead. So that the black line is the global M2 money supply. That's like pushed forward 12 weeks. So basically what this means is that, it's a signal that, okay, the price of Bitcoin has long been highly correlated with M2 money supply. M2 money supply is on the increase. And so therefore you might think
so basically
that,
saying the money has been already printed and it takes time, like 12 weeks, let's say, for it to be felt by Bitcoin.
Exactly. So those two things have got me pretty confidently bullish here. On the other hand, we have seen a pretty decent run up here in the last month or so. It might be time for a bit of a sideways action or even a correction before we go higher. I don't know if you have any thoughts, Andrei. What's your gut?
Yeah, I think we're definitely still bullish here. I don't really have what's the bearish catalyst right now, right? Like I don't see anything on the horizon. You've got all of the structural stuff that's really good, like you already mentioned. Tariffs done, mining supply drying up. Funding rates are really low on chain, so you can still borrow stablecoins for 2%. So seems like there's not a lot of leverage, right? So when you see the big crashes, it's usually leverage getting unwound, right? You don't see high funding rates. You can buy stablecoins for 2% right now on Aave or whatever, and then maybe more, maybe 4. So I don't see it being any sort of collapse or shock on any leverage. The macro looks good, liquidity looks good. I think it's up only. We're gonna break a new all-time high here in the next couple months.
Okay, nice. I think one other point that people have been talking about is the amount of Bitcoin on exchanges is at historical lows here, over as low as it's been in the last 2 or 3 years, I believe. So typically, of course, that means that long-term holders are just sort of stacking, and when the supply on exchanges goes back up, that means people are getting ready to sell.
Yeah, what we should look up maybe for the next time is how many Bitcoin are in the Bitcoin derivatives, like the wrapped Bitcoin and threshold Bitcoin and all of these Coinbase Bitcoin. I'd be curious if that has been a big factor in getting them off of exchanges and people using them in DeFi. Because I know the BTCFi trend is allegedly heating up. Allegedly, I don't know if that'll ever actually materialize, but I'm curious if that's also a big supply reduction where people are just in general moving more and more on chain. I just get this feeling that compared to 2017, on chain is pretty good. It doesn't seem nearly as, you still have all the problems of okay, what if I lose my keys or whatever, but in terms of trading, where would I rather trade these days? If I'm getting trying to get the new hot coin, it's definitely on chain. I'm not gonna go once it's on Binance, it's that's gonna be dumped 90%. So I wonder if that's also just a factor in the money leaving exchanges in general. Are we seeing a slow death in exchanges?
Interesting. Yeah. I think that that's probably a factor for sure. And long time in the coming, I would say.
It's finally over.
I've been talking. Yeah, I mean, self-custody is the way forward on chain. That's what it's all about here. And we've always, exchanges serve their purposes. but for this thing to really reach its full potential, it needs to be on chain.
Oh, and last bullish thing, I think it's really bullish for kind of what you talked about, the liquidity going up. More and more stable coins being printed, I think, is super bullish. That just means like huge amounts of on-chain liquidity, which means more big institutional players want to move on-chain. Like I don't know what the growth of like Tether and USDC is like, but you just have like a million stable coins now trying to pop up and get assets on chain. Everybody saw how good of a business Tether is, and it's like now it's like a new gold rush of I want to have my stable coin be the one that is most adopted.
Yep, I'm just bringing up the stablecoin growth chart on DeFi Llama. And yeah, we've seen a steady grind up since September 2023.
Was that 124 to 220?
Yeah, we're at 242 right now. So almost a doubling over the last less than 2 years.
Yeah, we got to see. I feel like at some point in this podcast, we're going to have like the chart of M2 money supply versus like percent of it in stable coins. Because this is like the massive, this is what can finally really kill banks. I think it's like, we had a theory that like Bitcoin was the one that killed banks. In a way it did. Really stable coins are what's going to kill banks. Because if like all the people are just like, instead of giving my money to a bank, why don't I just get stable coins, which are more liquid, easier to move? I can probably get better yields on them. I don't have to pay any fees. Like,
Yep.
Banking just becomes kind of like obsolete in a way there. So, anyways, in general, liquidity up, macro super good, mining profitable, all-time high coming soon.
All right. So with the gut check out of the way, let's move on to the drama that is unfolding right now in the Bitcoin space. So let me see if I can set this up here. So what's happened is that a debate, I suppose it's a fairly major debate, has emerged here in the Bitcoin development community over a proposal by developer Peter Todd to remove the longstanding guardrails like op return limits. Now, those guardrails are meant to determine the blockchains, to deter the blockchain's use for non-monetary data, often called spam. And Peter Todd argues that these limits are now meaningless because developers have found workarounds such as direct miner submissions and Bitcoin Core forks, making the restrictions effectively obsolete. And supporters see the proposed change here as being just an overdue cleanup that aligns Bitcoin with its current reality, while there are opponents, a few of which, notably, we have Jason Hughes from Ocean Mining, who warns that it could kill Bitcoin by opening the door to more spam, clogging the network, and eroding Bitcoin's identity as sound money. So he even called for mining pools to abandon Bitcoin Core if the change actually goes through. And we have a quote here from him. Jason Hughes, he says, Bitcoin Core developers are about to merge a change that turns Bitcoin into a worthless altcoin, and no one seems to care to do anything about it.
Yeah. A bit of an exaggeration, maybe.
Okay. Well, on the other side, we have voices like Antoine Ponceau from Chaincoin Labs. Sorry, my French, if that is French pronunciation, is just abysmal. And we also have Udi Wertheimer. He's the Taproot Wizards guy, and they're basically just saying that the concerns are overblown. Bitcoin's resilience isn't threatened by these relatively small, like relay policy changes, I guess you could call them. So that's the debate.
Yeah, I mean, I think like this is a classic Bitcoin debate where it's like hardline maxi versus very minor change coming up, and the hardline maxis is my opinion. Hardline maxis always say we cannot do anything ever because it's like a threat to Bitcoin. So I mean, you saw this in the Bitcoin Cash debate. Block size, I think even these days it's like more or less accepted. Like probably it wouldn't have made a big deal if you like raised the block size limit to 4 MB. Like people that are not hardcore maxis, I think a good amount of them would say like, yeah, probably wouldn't have ended up being a big deal. But for those kind of things, I think what you hit on is like, it's this feeling that it's now going to become a worthless altcoin because, you know, this is in the scripture of Bitcoin to remove this limit. Now, what this actually like does and why I think I guess he's threatened by it or like why he doesn't like it. I think a lot of the L2 type chains are looking to the BTCFi that I talked about a little bit earlier, are trying to use off return for storing some data. I think Citria is like a project specifically that was mentioned that wants to use off return to like store the proofs for their like L2. And I assume they've been like campaigning for something like this or one of the L2s if it wasn't Citria. So then, this becomes the whole hardcore debate of like, no, Bitcoin shouldn't be used for programmability. It needs to be only for sound money, and having L2s is blasphemous. Like if we have an L2, that's like total blasphemy on what we're trying to do. As a user, I don't think anyone's going to care. Like this will not impact or affect anybody actually using Bitcoin, and it just becomes like this whole nerdy debate. And yeah, this is just like the nature of governments. Of like how are things decided, I guess, is a really still a big question. Where it's like, okay, you have these like 4 or 5 maintainer guys, and this guy rallied, I don't know, however many people to downvote the PR, but it's going to get merged in anyway. Is that the correct way to do things? I mean, I don't know. That's how things are done, I guess. But I guess that's also just a question of like, what is it?
Yeah, I mean, look, as someone who, like I wasn't that involved last time we had this massive debate around, I wasn't paying that close attention in 2017. I know you were closer to things back then. And so I see I feel like I'm kind of like an outsider here. Okay. So I have less context, but when I see a tweet like this from Jameson Lopp, he says, every so often someone gets upset their arguments in a Bitcoin Core pull request fail to convince contributors. So they take their grievance to social media. Then many non-contributors pile into the PR under the naive assumption that Core is democracy governed by votes. So when I saw this, I was thinking, how does it actually work? Like this whole Bitcoin governance thing, right? Like you've got few people maintaining the Bitcoin Core, and that they're proposing this change. Then you got people complaining about it on social media. Like, who actually makes the decision? It's very unclear to me. People always talk about rough consensus and the influence of many different parties on the governance process, but like, it seems like what this Jameson Lopp guy is saying is that no, we just like make these changes. It's not really up for debate. Or am I completely misreading that?
Well, I think there's like a few things. Like certain changes are going to, I guess it like depends on the scale of the change, right? So like a certain one change might require, we'll say like the biggest change is going to require like a hard fork. So it's like basically saying, miners, you need to upgrade to this like new version, and everyone needs to start using this. Otherwise, like you will no longer be mining Bitcoin, essentially. Um, so I think those are like where the like minor consensus comes in, where it's not just the developers, the miners are involved, because if there was like a change that wasn't um, backwards compatible, it would require like a hard fork, and for the miners to be involved. For like sorry, not like a Bitcoin miner, like for small changes, like things like this, that's not necessary, right? Like so, um, you could just be a miner and keep an upgrade, and you'd still be on Bitcoin. It wouldn't matter. For stuff like that, right? Like it's um, the developers, I guess, have a lot more sway, and they can just kind of merge it in as like the biggest client. And for that, like, yeah, it's probably like 5, 10 guys that really like decide things here. Um, in terms of like real contributors and people who can actually like merge pull requests and
Yeah.
approve pull requests, it's probably like 5 to 10 guys on the core
So
client.
I guess what I don't understand is how exactly are we defining like a minor change that can be done by these 5 or 10 guys versus one that requires broad consensus across like the whole milieu of Bitcoin holders and industry.
I mean, I honestly like it's really hard to tell. Like, I honestly think a lot of people are in that group, or like Jameson, where they just don't care. Like, right? Like, it's like exactly what he's talking about. It's like just some guy shouting at you that you like don't even know, and he's just yelling, and you're just sitting there like, I'm just trying to make Bitcoin better, or whatever. Um, so I feel like the governance process was like very soft. Um, and at the end of the day, if enough people hate it, they can go fork and make their own chain. Like that's kind of like there is some form of oligarchy or dictatorship or cabal that ultimately does run this stuff. Which, I mean, that's just how like it has to work. Like it's not some sort of vote.
Yeah. So then I think there's this point which is raised by this guy Samson Mow, who's another Bitcoin KOL, and he says Bitcoin Core is not a democracy governed by votes. It's supposed to be based on rough consensus. And then he says anyone can see that there is no consensus on relaxing op return limits. Pushing ahead on this change is going down a slippery slope. So it's the slippery slope argument. And at least from his perspective, he feels like this is a controversial change, and if these like small group of core developers can implement the change, then it's a slippery slope to things that could really have a big impact on Bitcoin.
I mean, I think like in the future there will just like always be this like situation where eventually enough people will get dissatisfied um, and fork and make their own chain. Like it's almost like inevitable, right? You either have no changes, which means um, you know that's it. Then everything will always be the same. There will only be one Bitcoin, or you keep making changes. And if you keep making changes, there is no possible way to make everyone happy with the changes that you are going to make. It's not possible. This isn't like some sort of I mean, it's just like any other form of politics, right? Like some people are not going to like it. If enough people don't like it, if enough people are pissed off enough, they have this option to eject and create their own chain. Until that point, like you kind of have to accept that you're, not in a democracy that's run by an oligarchy. Now, and then you have to determine for yourself, is that a benevolent dictatorship or like a malicious dictatorship? So that's my take. Whereas like there's always going to be this option to fork off, and there probably will be many more forks because there will be some change in the future where somebody's pissed off about something. That's my take.
Okay. All right. Unless we have anything else to discuss here on this Bitcoin governance topic, let's move on to the RWA stuff. This is quite interesting. So, hold on a sec here. So, Securitize and Gauntlet have launched a new leveraged real-world asset investment strategy using the tokenized Apollo Credit Fund, or ACRED, and it's on Polygon POS. So investors can deposit ACRED tokens into a smart vault, which is managed by Gauntlet. That uses the tokens as collateral on Morpho to borrow USDC, which is then used to buy more ACRED, creating a leveraged loop. And supposedly this is a carefully risk-managed loop, and it runs automatically without manual intervention. Why is this story or development significant?
Yeah. So I think we got to like break down into definitely a few things here because there's a lot going on. So I think like first we can talk about yield leverage and how it works, and like this DeFi strategy in general. So, you have ETH and you have like Steth. So ETH is the non-staked version, and Steth is the staked version. If you have the staked version, you're going to get 3% from like the yield, right? So it's kind of better to have the staked version compared to the non-staked version because you basically get free money. Now, for a lot of people, 3% is not a lot. So they want to use leverage to try and increase that from 3% to 10% or whatever. So the way to do this is you buy Steth. So let's say I have 10 Steth. I deposit it as collateral, and then I borrow ETH. Let's say I get 5 ETH from that. I use that 5 ETH to buy 5, won't be exact, but 5 Steth. So now you have 15 Steth instead of 10 Steth, and you basically now have leverage. So now you have 50% more Steth, and you can get 50% more yield. That's super simplifying it, but now your yield is 4.5% on the ETH that you had compared to 3%. And you can run this loop over and over and over. Okay.
Just to interrupt for a second there. So what happens if you've borrowed Steth or ETH?
You've borrowed ETH.
Okay. And what happens if you've used your Steth as collateral to borrow ETH? Right?
Yes, correct.
Okay. Now, what happens if the price of Steth / ETH goes down in that there?
So this is like the good point. The good point is for this, if the price of ETH goes down, then the price of Steth is also going to go down. So you don't have a really high chance of being like liquidated, because if the price of let's consider if it was like ETH and USDC, then it's exactly the problem you just mentioned where, okay, now I need like 10% more ETH to maintain my loan ratio. But for ETH and Steth, since they're both going to move up and down at the same rate, in theory, you don't have this like issue where you now have like a higher loan than you expected. So people will crank this leverage way, way, way up. And what ends up happening is like, you might be sitting on something that has like a 1% drop liquidation rate, like which is like super aggressive. But since ETH and Steth are moving in a correlated way, you're not gonna really, in theory, have that unless there's like a deep situation. So you can crank up the yield a lot more, but not have to worry nearly as much of the liquidation risk compared to if you were doing like BTC and USDC. These are the loops.
People are able to take what would normally be like call it 3% yield just by staking ETH. And they're able to, using this strategy, they're able to crank that up to like, how high are we talking?
For like Steth and ETH, it probably won't be that high just because like basically what you need to look at then is the difference between the borrow rate and the staking rate. So like right now on Aave, it might be 2.5% to borrow ETH. And the difference between 2.5 and 3 is only 0.5%. So then you can do that like X amount of times, and you'll probably only get up to like 5%. But this is like for a basic, like super liquid, super common like pair. For like other assets, you can get way better returns on equity. Like you might be talking like 30x return on equity for some of these like we can call more exotic yield bearing assets. And obviously like even for like 2%, like 2% isn't a lot if you have like $100. If you have $100 million, which people do on chain, 2% is a lot.
Sure. Okay.
Okay. So then we can go into actually like what's going on here.
Yeah.
And so kind of the example I kind of gave the whole time was about Steth and ETH. So like we can talk about what is ACRED even. So ACRED is basically a managed private credit fund, and they're taking in money, they're loaning it out to like corporations to they might have some T-bills in there. I don't know. They have like a basket of assets that are backing their debt, and what that's yielding for investors is 10%. So I think they're supposed to give quarterly payouts to their investors, and on an annual basis, it's like 10%. So basically, if you have this ACRED token, you can kind of think of it as like I have a token that is yielding 10%. So if I can use this collateral and I can get USDC, and let's say the USDC funding rate is like 3%, okay, now I can just buy more ACRED. So if I borrowed at 3% and bought the thing that is yielding at 10%, well, I just basically made free money with no additional like risk exposure except for the liquidations.
Is ACRED token stable, volatile?
Yeah, so this is like the thing that I'm not super sure about, like how these are going to work. Like, I don't know if it's officially launched yet or not. Like, I don't know if they're actually going to do the payouts on chain, or you have to like redeposit it to their like centralized thing and then they'll give you a payout, or like what's actually the situation of the mechanics there. But yeah, that's like I'd be curious to see like when they launch, what's like the real mechanics of it.
Okay. So what is the significance of this? Why is this important?
So I think like with private credit markets are like one of the largest markets by like actual volume in the world, right? So compared to like equities, debt is much more traded. There's a lot more debt volume in general, and if we're starting to see that debt move on to chain, What I think is basically going to happen is just a lot more liquidity, a lot more opportunities for investors to invest in things we can call them more traditional, more stable. So instead of having to buy, some shitcoin, you actually have now an opportunity to buy like a debt fund that's going to give you 10%. It might not be sexy, but maybe if you're an OG Bitcoin holder, you don't want to be buying meme coins. You want to be buying, we could call them big boy instruments or like whatever we want to call them. And basically getting this access and opportunity, way more volume, like we can call way more sophisticated assets. And I think just a lot more activity on the DeFi networks. So this is why I'm bullish on ETH. All of this stuff is happening on ETH. And I would expect to see way, way more DeFi activity, which I think is like ultimately why people use ETH. Like I think there's still a lot of stuff like NFTs, meme coins, whatever. But in my heart of hearts, I really think DeFi is like the thing that is like the real use case of Ethereum, and like the use case beyond just holding Bitcoin is that you can have these like DeFi networks. So just way more activity and way more sophistication opportunities for people that are like participating in DeFi is why I think it's like big.
Okay, so this Apollo Credit Fund, I'm reading that it's a $500 billion asset manager from the TradFi space. They're stepping into DeFi. So that's the real significance here. It's a big respected player moving things on chain.
Yeah, I think it's like, and it's no longer, it's like, I feel like the floodgates are now like totally open into that direction with we can call it crime season or Trump presidency. Like there was like a huge barrier for people to like move assets on chain. And the moment you have like Trump presidency, stable coin volume, which is basically TradFi assets moving on chain, way up. You have stuff like this coming on, way up. And like I saw even an article today, or like somebody raised a Series A round for moving equities on chain. Like all of this stuff is just going to happen. And I do think that we're like a couple years away from really seeing like, hey, you can really do the majority of your like financial investing on a blockchain network compared to, I don't know. I don't even know what calling BlackRock, calling JP Morgan and trying to get in there.
So why are these institutional players using the on-chain rails? What's the advantage for them?
I think there's a couple things. One is probably the access to like a new customer base, right? So like if this Apollo Credit Fund was not launching on Ethereum, would anyone in like the retail space like care or know about it? Would anybody have access to it? No, right? Because it'd probably be only for like institutional investors. They're probably like they have to I don't even know, cold call people, like how they find clients. But now you've basically opened up an entire worldwide customer base to this like credit product that you have.
Right. So they're tapping into the wealth that's already in the crypto space. That's one reason.
Okay. I think that's at least that. I think that's like honestly one of the biggest ones where it's like the amount of wealth is like there and it's just like continuing to grow, right? Like the wealth in crypto is not going down, it's only going up. So you kind of want to be like a front runner in that space. And I think it's also it's the liquidity, right? So before, your private credit fund is going to be extremely illiquid. You're only going to be able to redeem it through the issuer. It would be my guess, right? Like now it's actually tradable, right? Like so you've tokenized it, it's tradable. people can buy and sell that freely, and that would create a lot more liquidity for your fund when you're attracting new customers to say like, hey, I got this token on chain. You'll even be able to like trade it or sell it whenever you want. I think the liquidity that the blockchain networks can provide is really big. And you basically have one centralized custodian, let everybody else manage their own funds. So liquidity and access to crypto money. As we saw with Trump's election, crypto money is big money. It's crypto money is not small money anymore.
Okay, so what about the compliance question? So I read that this project uses S tokens with compliance built in. I'm not sure exactly what that means, but
compliance. It's crime season, Graham. No, I'm just kidding. So I think they're trying to do something where like they'll like have like attestations where maybe they'll have like a whitelist, or like you have to be able to prove your net worth, or like some criteria. Like so they'll still have some criteria like this is only accessible if you, my guess is net worth is probably one of them. And they basically want to have some like token or something on chain to prove that like, hey, your wallet has the minimum net worth to be able to buy this fund for compliance reasons.
Yeah.
So I think this is kind of like
Yeah. So they're not opening it up to just anyone. They are accessing a new pool of capital, like the people in crypto, but there are some restrictions here.
Yeah, we'll see. I'd be curious if it'd be like you would need that token for the same way like with Tether. Like you can trade Tether freely, but you have to be like a KYC'd institution to mint or redeem. I'd be curious if they end up running it like that, or if they do something, potentially they can do something more strict where it's like you can't even send the token to somebody on a whitelist. But over time, that'll get like whittled down to be more like the Tether type system, where maybe to redeem an issue, you have to be like some institution or something. But to just like trade it or hold it, you could just be anybody.
Okay. So let's zoom out a bit and maybe look at how this particular launch fits into the bigger RWA picture. So there was this report from Deloitte. They still exist. They still publish reports, even though the ChatGPT 4.0 model can probably produce the reasoning, the better reports. Anyway, sorry. So some interesting data from Deloitte, which is okay. So they're predicting that the tokenized real estate market is projected to grow from what it is currently around 300 billion to 4 trillion by 2035. So that would be a 27% compound annual growth rate. So basically, Deloitte is predicting that RWAs, especially the real estate sector, is going to grow massively. Does this, how connected is that to the Apollo thing we just talked about?
Well, I think it's very similar. And the way I think why they might have hit on real estate in particular, I'm not sure about this, because I think what a lot of big Bitcoin holders or like big whales are looking for is income, right? So you might have like a ton of big Bitcoin that might go up in value a lot, but you don't want to sell your Bitcoin, right? But how are you going to pay for your bills? So what you want are things that can somehow generate income. So like stuff like this private credit, stuff like this real estate, if you own that somehow, then that has the possibility of generating you income. And as a Bitcoin holder, you put up your Bitcoin maybe as collateral, you get access to this real estate trust or like whatever it is that pays 5%, and now you have income, right? So I think these types of debt, real estate, fixed income instruments are just going to keep growing and growing and growing. And it's the same thing for like real estate. They just want investors, right? They don't care if you're a Bitcoin holder or whatever. They just want more clients to buy their fund.
Okay. What do you see as the most exciting or disruptive use cases, like from this RWA tokenization trend? Like, is it something like the credit loops that we talked about with Acred and Apollo? Or is it this fractional real estate, maybe tokenized debt, something else entirely? What's the most exciting or disruptive from your perspective?
I mean, I think the most exciting root of all of this is being able to have Bitcoin. Say I have one Bitcoin, and take a loan on it. Say the loan needs to be very easy to manage. I don't want to actually deal with it too much. So then I have whatever, $500,000. Or yeah, that's what Bitcoin's $1 million. Let's say I have $50,000 in today's terms. And then I can buy something like this tokenized real estate fund, and it's going to give me income. It's going to give me yield. Okay, so now I'm going to keep all of my Bitcoin exposure, and on that 50,000, I'm just going to say 10%. Now I'm generating 5,000 a year in addition to holding all of my Bitcoin. Okay, so now you're fully blockchain native. Now, which instruments are going to let you do that? I'm not sure. Tokenized real estate sounds good. Something like that ACRED fund, private debt, that could be good, because all crypto holders are essentially speculating on the upside. So this is what I didn't understand, or like I think I was wrong about, where I thought equities would come on chain first, because I thought, okay, like equities, that's what everybody wants. But it's like, if you have Bitcoin, like you're sitting there thinking it's going to do way better than equities. You're not speculating on the upside. I'm not going to use my Bitcoin to buy stock. It doesn't like make sense, because I already think my Bitcoin is going to go way up. My problem that I have is I have all of my Bitcoin, but I have no cash to actually spend on something. So you need to somehow use your Bitcoin to unlock that, or Ethereum or any of these other assets. So that's really, in my opinion, the exciting thing. And I think the institutions are the ones that are going to be able to offer this through a variety of vehicles, like this tokenized real estate fund, or credit fund like the ACRED. I think that will just be an absolutely massive market, and keep moving things on chain, right? Because you can't have your Bitcoin on an exchange and get access to this. It has to be done on DeFi. It can't be done on an exchange. So everything just keeps shifting more and more to on-chain activity, more real-world asset exposure for crypto users. Good time to be alive. Good time to be a Bitcoin holder.
Yeah, so if you're a Bitcoin or crypto holder, you've got decent holdings, what these products enable you to do is not sell your Bitcoin and crypto, and instead get some cash flow, get a way to earn yield, or buy a swimming pool or whatever, if you want to just take the money, right? Like take out a loan, and then I guess pay it back slowly without having to sell your Bitcoin up front, right?
Yeah, and right, like that's like the meme keeps growing, right? Never sell your Bitcoin, and it's just going to be it's getting easier every day to not sell your Bitcoin.
Yeah, so I think that also, you could argue that is just bullish for Bitcoin, right? Because it ultimately means less sell pressure if you never have to sell because these products exist, then you won't sell.
Yeah, for sure. Right? Like if I just have my crypto, it's the same way people use like credit cards, right? Like we don't think about credit cards as like even debt anymore. It's just like I don't want to pay right now. I'll pay when I get my paycheck at the end of the month. Right? Like I did, so I could easily see that same mentality once the UX gets a little bit better, once things are streamlined a little bit more. It's like I don't want to sell my Bitcoin. I will just rack up my debt until I get my paycheck or like whatever. You know, I can settle it later.
Yeah. Okay, good stuff. I'm excited. Let's wrap things up here with a new segment that I'd like to try out, which I'm calling the Bitcoin inspired truth of the week. And this one is from a Twitter personality known as BitPain. And he says, when central banks print money or cut rates, they unilaterally renegotiate every single fiat denominated contract in the entire economy. You have a signed contract with your employer to trade your time for a certain amount of real value. When the money is debased, you get a pay cut in real terms to which neither you nor your employer consented. This is by far the most important function Bitcoin serves. It restores the incorruptibility of contracts and property rights. When I read this, I was like, yeah, rah, rah. Hell yeah. I like that.
I mean, he's not wrong, right? Like I think that's exactly what happens if the monetary policy changes not in your favor. Like, you just get screwed. Um, you need to have some way of being able to opt out of the current monetary policy in your uh, jurisdiction or where you live or whatever. Because yeah, like it's a big difference if you live in Argentina or something and your currency just gets screwed just because like you live there. It's like, man, well, this sucks. um, wish there was a way for that not to happen. Good truth. I want to see more truths, Graham.
And it's not just like so-called basket case countries like Argentina. You know, it's everyone. Everyone's money is being debased. Some places faster than others, but even in the slow places, it's happening.
I mean, this is really why I love like the Doge initiative and like things like that in general, where it's just like, man, do people really want their money to be spent on these things? like what is the point of all of this like spending for like no visible benefit, right? So I feel like that's like finally been, I guess, unearthed and almost like a consequence of like the Bitcoin era, where you know, people already thought like the monetary policies were not good, but then you just like go into the spending policies and like the budgets, and you're just like, what the hell is going on here? Like, why is my money being used for this? And then the currency is getting debased afterwards.
Yeah. It's interesting that you say the Doge stuff might be in part a consequence of the Bitcoin era. I like that concept. It's something that Bitcoiners have always talked about. It's attracted me to it as well. It's like, okay, Bitcoin is the thing that it's a way to sort of keep governments in check, right? If this escape valve exists, what it does is it forces governments to be a little more responsible with their spending, which ultimately, that's what we want. That's good for society. We don't want wasted spending.
Yeah, it's really crazy that this like trend has only like emerged in the past 5 years. Like, it really, I don't know, maybe I'm like too young to like, at least like in my era of politics. Yeah, I could probably go to George Bush. Like, no one was ever talking about like responsible spending, or like maybe they were, but it didn't seem like anything was like seriously happening on that front. I don't know if they ever like accomplished anything there. But this like really seems like it'll be a worldwide, I guess, zeitgeist now. Maybe it's because growth is drying up, so now they have to be more responsible. But yeah, I don't know.
Yeah, well, it remains to be seen how responsible they'll end up being. People talk constantly about the Trump put, like how much pain can they take, for example, with these policies before they, cry uncle and turn on the spigots again to give people their bread in circuses. Which, as we know, that's always good for the price of Bitcoin. But yeah, it's there. Bringing back to my point, I guess, which it's Bitcoin is there as perhaps a warning, to governments, don't get too out of control, because the people will move to the harder currency.
They're gonna get forked. If you don't like op return,
Yeah,
you gotta get forked.
All right, Andrei, that was really good. Let's wrap it up. Thanks for everyone, and thanks to everyone for listening to another episode of Bitcoin.com's Token Narratives. We'll see you at the same time next week. Adios.
Thanks.